Hey guys, welcome back to lesson 6 of the cryptocurrency course. In this lesson, we will be focusing on the head and shoulders formation, which can be seen frequently throughout the cryptocurrency market, the indices market, the forex market, commodities. It's a very common and reoccurring chart formation that can massively improve your trading. It's one of the sole formations and patterns I actually look for when it comes to charting. So as many of you know, when it comes to me trading, first of all, psychologically, I eradicate anything that can potentially cause more of a distraction than necessary, hence the candlestick colors. One thing I also do not do in trading is actually look for the generic or the stereotypical formation, so like ping bars, hanging mans, or bullish engulfing, bearish engulfing. I do not really look for that stuff because, as a good example here, let's go to innovation color. That's quite bright. I haven't used bright charts in a while, but just as an example, as a bearish candle, which is obviously this one being blue here, traditional trading methods teach you that upon confirmation of a candle closure, such as one like this, which fully engulfs the prior candle, a bearish candle in this instance, it's a good sell indicator. Now, traditional methods would tell you to execute upon the closure of this candle being confirmation, and then potentially placing a stop loss above this candle, which obviously could reap some good rewards if you were to potentially hold for a very long period of time, down to here, maybe lower. But just putting this into perspective immediately off the bat, even if you were to hold to make 2% off this trade, you would need a very wide stop loss first and foremost, and even then it almost would have got stopped out. And secondly, for a 2% reward to hold from almost an entire year to make 2% is not worth my time, and it shouldn't be worth anyone's time. And traditional methods always tell you to await those confirmation signals, or a bullish engulfing, for example here, bullish engulfing, or even here, a bullish engulfing candle. So as you can see, if you were to enter upon the confirmation of that candle and then place the stop loss either here with a target of maybe here, you're making around 1% with a massive downside risk, and of course the upside potential is not great. One of the ways I managed to get very good entries, if I just go back to innovation gradient, much easier to see, when it comes to getting those optimal entries and when it comes to getting some of the highest precision trades, this is where I start to utilize everything they do not teach you. So in a way, the very basic stuff again, as we covered in the last lesson, like grid lines, focusing on the grids, focusing on the wicks, focusing on the bodies, not necessarily the confirmation. Sometimes the best trades you can physically get are the trades you take when the confirmation does not look solid, and using multiple different confluences and things that I'll be teaching you as we progress into the next lessons. Even though you should have got a basic understanding already from the first 5 lessons, let's just say we used the grid lines. Grid lines here, grid lines here. Instead of waiting for this huge candle to come down, close, and confirm a bullish bias, why wouldn't we just mark out the grid line here from where the prior grids were located, wait for a pullback alongside using a Fibonacci tool. It then correlates with the levels. You then have a very nice trade, and therefore by looking around this region, even if it was not a perfect entry from there, stop loss can be much smaller, and now you're making over 3.5% on a trade like this in a very short span of time. Literally within a week or so, you've made 3.5% by simply using the indicator that they tell you to execute from as a potential confirmation, then waiting for the pullbacks to come through, and then entering from there. That's just an example. This is something that will be coming later on down the line, but it's a good introduction into the likes of the head and shoulders pattern. Now, to the best of my knowledge, you can use a head and shoulders tool here on TradingView, located below the text tools and the marker tools. You can go to head and shoulders, and I've forgotten how you mark this out, but left shoulder, a perfect instant example, we'll mark that around there just to make it flat, and then the right shoulder there. So why this is not, there we go. So in a nutshell, maybe we should change this a little bit, make this white and then fade it. I want to make it apparent but not too apparent, and then from here I think blue will do the trick. That's perfect. We'll shall we also thin those lines out a bit? So in a nutshell, make that black to see. So in a nutshell, the head and shoulders formation is exactly what it says and does on the tin. The left shoulder, as you can see, there's a shoulder, there's a head, and then there's a right shoulder. This is a very common pattern, and it frequently occurs throughout all different time frames and all different markets. And by utilizing this, it gives you a great potential to combine with support and resistance, grid lines, Fibonacci's, trend lines. Using and understanding this basic formation can aid your trading so much more, because you're easily able to start identifying where the next potential move in the market would be. So using this as a rough example, and also the psychology behind the head and shoulders formation. So if you've seen the prior lesson, especially the lesson on wicks, you would have become aware, and when you see in the next lesson regarding the next candlestick formation I'll be discussing, you will notice when a key level is often solidified, there's normally a false breakout higher before price then comes back below into that trading region. So in this instance here, this would have been the trading region. Price then trades through, breaks above, comes back down, retests, goes back down again, and then easily you can see where the next level would then correlate. So in a way, you wouldn't even need to use this. You could simply use the rectangular tool to mark out the first shoulder, left shoulder. Obviously in the inverse, we'll get to that in a minute as well. But very simply, by drawing a box here, you can see that once we've broken out the box, we've come back down. Even that would have been the right shoulder technically. That could have been the entry in itself, as it corresponded with the prior level. Could have easily made 2%, maybe even more, depending on where your stop loss was. But all in all, this is an excellent way to start identifying false potential breakouts in the market. So the easiest way to do this, if I was to flip this upside down, just so you can see as well, the same occurs. This would still be an inverse head and shoulders. So when we are on the correct side of the chart, you will often see a head and shoulders formation on the inverse as well. So the shoulder, the head, the shoulder, going back to the correct side. This is a beautiful way to potentially execute and identify trades, because what you can do in this instance is, let's just say the shoulder has been formed, we've broken above, and now we've seen the pullback lower. Now we know we've got a head and a shoulder forming. At this point in time, we can stretch this out to around here, from this point of around $10,800. Also note that if I dragged this lower, the grid line there at 10,800 as well, you've got prior correlating price action. So if we put this at 10.8 and then drag this across, we can see historically this level has come into play many times, and there's been the utmost respect for this level several times. So it's very clearly a valid level. Now what we would do in a particular instance like this is potentially plot a Fibonacci down to here. We could also include the 50% retracement. It's not always the case, but in this case it would have been beautiful. We can see very clearly here what we would have been waiting for is looking at where the first shoulder kind of correlated with a Fibonacci tool. I'm going to get into the Fibonacci's in much more depth in future lessons, but just as a pure theoretical example, as we could have seen from the high to the low, even if it was from there, the 50% retracement on the Fibonacci tool correlated precisely with the left shoulder, which means when we're coming back up, we want to pay a particular attention. If I get rid of this and redraw this tool for you guys, just to make things a bit clearer, and plot it from around there. So if we do that, make it nice and clean. So as we can see, the left shoulder's here, the right shoulder's here, the head is here. So looking at how the 50% retracement historically correlates very nicely alongside the 61.8% retracement correlating over there, we would then be looking for entries within this region here, because we know the probability now that this was a false move has become stronger. So if I was to plot this here, again, the charts look very messy. We would never normally have them with all of these tools on at once, but just for visibility purposes, we broke below, we retested resistance, we came down, we broke through, the momentum was short-lived, we then absolutely dumped back down to the prior support floor that we were trading from here. So using a combination of all the different lesson teachings so far, we can see we're structured within the house, the false breakout comes in, we dump back down, we retest again, then we absolutely die. So the psychology behind this is once that floor has been solidified and the false move comes through, this is normally a stop loss hunting tactic, as all of the traders who would have been following this principle here of entering short likely would have had stop losses upon this bearish engulfing anywhere from above this candle here to around these regions here, because bearing in mind, if they did have a wide stop loss and then price started dropping, when it comes back, people do not expect it to always go back to where it currently was. So just thinking psychologically, if you were in this trade short there, you've just endured a massive swing against you, it's pulled back down, you're likely going to put your stop loss either at break even or in a little bit of a less loss than what it would have been if it went to the full extent. So let's just say it's come down into profit, you're going for a much larger swing, because obviously if you're entering short from here, you're not going to make much money having a stop loss this wide. So when it goes down, you're going to put the stop loss either lower or at break even, or you're just going to hold it. So what the market makers are doing, they are coming in to drive out all of the short positions, liquidate everyone, gain the necessary liquidity, dump price back down. Then it becomes solidified that this was in fact a false move when you see the rejection come back down. So we see price come back into this territory, fails to break above, fails to break above again. So anywhere within this zone would have been an entry zone. By simply spiking into this zone, you could have entered here. Stop loss could be above the Fibonacci tool. This is something that will come later on. Then you could have targeted the next Fibonacci, whether that's down there or down there. Now, as you can see, whether it was there, whether it was there, or whether it was there, you still would have made a decent amount of money in the space of weeks. That would have been around 3.5%. You could have held this much longer and it could have absolutely died. But again, not everything's guaranteed. Remember that. So if you held it all the way down here, you would have made around 4.5%. And there are often much better opportunities. But because this is the daily time frame, using that head and shoulders as a good example, there are opportunities once executing a swing from the daily to potentially go down to the 4 hour, the 1 hour, the 5 minute and execute intraday trades within that. This is something the innovation markets community are now aware of, as this is one of our key principles of teaching trading patterns and just trading in general. So if we go over to the inverse here, I immediately see another one. Always different patterns, it's always reoccurring. So we can just kind of go through and start anticipating potential head and shoulder formations. So we'll make it a bit messy, doesn't have to be perfect, just so you get the overall gist of what we're looking at here. Right shoulder again, plot that there, bang. So from the inverse, we can see yet again, if we were to plot that from around the wick there to the candle body, what we can see very clearly, we've come down to support, solidified and reversed. The short positions, or the long positions, sorry, people that would have gone long around here, for example, obviously stops would either have been near this wick, above this wick, or now at break even after going into profit. So naturally, all of the shorters would have been anticipating the longers, the people who went long from this region would have had stop losses either within this vicinity or they would have put it to break even. So the manipulative drivers of the market, the institutions, the whales, the funds, everyone that controls the market, drive price down, false move. And what happens here in this instance is the people that have gone long either panic and then shift to short because their positions have been broken, false move, stop above here, place it down maybe to anticipate a move like this. So you're either switching positions because this level has now been broken, support turns resistance, very quickly and instantly this then reverses back to signify a false move, which is why we do not always execute upon the first break of a support and resistance level, especially when it's first been solidified, because very frequently it's a false move. And if we went to the 4 hour time frame, what would have happened is, in this particular instance, if people did not enter from here, and bearing in mind looking at the 4 hour time frame, there are actually many different head and shoulders within other head and shoulders, which we'll get to in a second. But within this move in itself, when we broke through the support floor and then came back and retested here, this is where people would have been looking to go short. Let's just say stops anywhere in this region, looking to go lower. However, it didn't sustain, showing how false this move was. And also, another little lesson for you all, correlating with the prior lesson on wicks. See the wick here? Price did not actually breach below. The higher time frames, the 4 hour, the daily, the candle bodies did not breach this region, which is where the real area of liquidity is. So price comes down, false move, fulfills this area, spikes back up. And then if we plot another Fibonacci tool from here to there, comes back up, same support floor, and guess what? Perfect 61.8% retracement. Fibonacci targets there. This is where we enter. Once the longers have been wiped out and the shorters have been wiped out, then we utilize their downfalls to identify a good trading opportunity. So in this instance here, we could have had a stop below the 78.6. We could have put this up at the targets, could have made 5% literally off the bat, off a very high precision entry. And this is where patience comes into play as well. But what's important to note is within this shorter time frame, within the 4 hour time frame, can you see again another head and shoulders formation? Shoulder, head, shoulder. If you want, we can get the tool up again for the sake of it. And there, plot that down. Let's push this a little bit lower. There we go. So again, very messy, not the easiest way to draw it on these charts, but have a look at this once again. Shoulder, head, shoulder. So what we do is we get the wick, we get the body there as well, but all we can see is very clearly the other move. We've seen a huge area of resistance. Price pulls back, it then breaches through. If you can see yet again, it breaks through, it retests. This is probably where everyone then tries to go long. Stop loss back in this area, bang, they get annihilated. And again, following the exact same pattern that I just showed you, if we were to simply eradicate the overall idea of a head and shoulders and just drew a zone, the exact same principle applies here. So if we draw that there, false move, comes back down to test the support, comes back up, fulfills the head and shoulders, dumps. If we were yet again to plot a Fibonacci tool here, if you want to see perfection in work, get rid of that 50%. I do not really use it. As you can see, yet again, you could have shorted from the zone here. Stop could have either been above the 78.6 or just even above there, but overall it probably would have been around there. Looking at the first target, that's an easy 3%. It's come straight down to the Fibonacci extension, correlating with the 61.8, another very high probability setup. So let's clear the chart again and see what else we can find, and just show you how many times you can actually identify these continuously throughout the market. And this is just Bitcoin as an example. There are many different pairs you can do this on. A good example is XRP right now. As you guys know, I've got the buy limit set at 20 cents. Well, conveniently, you've got the wick, you've got the false move. This is literally correlating with everything that we've just covered, and this is why I believe XRP could come down into this region, because you've got the shoulder, you've got the head. Maybe it will do another false move and then do it again, but regardless, from a long-term perspective, you can still utilize this to your advantage. So as you can see, the wick wasn't breached, the head spiked through on the 4 hour, came back, boom, retested. Let's continue. So hopefully, if this comes back down, you've got the shoulder, head, potential right shoulder, boom. This could then correlate precisely with that as well. So let's go back to this. Let's have a look at some more. So immediately, again, put that from high to low. We actually fell short on this one. It wouldn't have been the best of trades because the target wasn't met. But as you can see from, oh no, sorry, my apologies, it actually would have been a good trade because this wasn't formed yet. We actually would have entered here. I've just realized what's going on. So again, simple stuff for visibility purposes. Bang, bang, push that lower, shoulder, head, shoulder. What does that correlate with? Once you go from A to B to C to D, that would have actually been an instant profitable trade. So if we entered from here, stop above the 78.6, pushing this down to the first target, 3.5% just like that. And it would have been very easy to do so, because as long as the stop is above here, maybe even there, you still made 3%, and that would have occurred within 8 hours. That would have been 2 candles that would have just slammed down and hit your target. Once that's fulfilled, it breaks and continues. But what's interesting is you could have actually caught a consecutive trade from there, because if we look on the inverse all of a sudden, and this is, again, over time, guys, you will learn and you will condition and your eyes will become trained to actually identifying all of this stuff. It takes a while. It's not something that will naturally just come. It will take a long time for your minds to actually figure out exactly what's going on. So pay attention, have a little look at this, and then very simply, all we do now, switch this over there. Shoulder, the head. If we go to the daily, how would that look on the daily? Even on the daily, that would have been a head and shoulders. So as we can see, wick galore, wicks, 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 shoulder, head, shoulder. If we'd done this on the daily, I believe this would have been a 61.8. Yep, that would have been fantastic. So yet again, entry here, stop below. You could have made, in this particular instance, especially with that huge upside move, I believe many people would have closed from that wick. That would have been 10% plus. That could have even been 14% by simply abiding by the head and shoulders principles. And it just occurs continuously throughout the market. It really is a reoccurring theme. So let's have a little look at the 4 hour. If the 4 hour loads, there we go. So just one more example here as well. So as you can see, the shoulder, head, shoulder, retest, boom, continuation. This could then form a trend line in the future as well. There are so many different things that can occur from this. Now, if you look at this over here, if we just put that from the first point, from point to point, later on down the line, this then also forms a trend line. Now, imagine if you entered there. Simply from that retest, stop loss could have been below the trend line, below that wick, ridden that wave up, you would have made 8%, 8.5%, simply by abiding by the principles. Very simple stuff. And honestly, the more you train yourself to identify these on the inverse and the other side of the chart, you will easily be able to just spot these and use this in line with your overall analysis. Even if you do not use it, as you can see here, just perfection. Even if you do not use them frequently, use it to help identify if your trade may be doing the correct thing. They are everywhere, especially in Bitcoin. It seems to be, I don't know, like a fan favorite of institutions to do this. I mean, this is a clean head and shoulders. Shoulder, two shoulders, a bit of a deformity. Head breaks through, comes back down, rejects, drives out everyone. Plot of Fibonacci from high to low. Bang. 61.8 comes through. Where do we go down there? Plot it above the fib. Drive this down. Lord and behold, you've made almost 5%, and you would have made more than that. You would have made 6% off that setup with very low risk but very high reward. This is the beauty of the head and shoulders formation, because when they work, boy, do they work. And it's actually very rare for them to really fulfill the 78.6% retracement. So if you can utilize all of those different signs and just start to figure out these patterns, you're going to see a major increase in your trading output and also your profits as well. So let's go a bit higher. Let's see if there's anything in the present day that could be occurring. So this would have been a beautiful opportunity if it did come through. Let's just say there, if this came through, let's just say there was a movement around there and it came back and taps, that would have been a beautiful trade, but we didn't see that come through. But just as an example, this is what we would kind of be looking at in those moments. So during these moments in time where you've seen this form, then you've seen the false move come through. Once it breaks above, we would then be looking for a retest to then enter from this region here. So this is, even though it didn't form, is a beautiful example of what you would be looking for in that moment in time. This would have been a short-term trade, not as profitable, to be honest with you, because it wasn't a real severe breakout to the upside. But again, shoulder, head, shoulder, only a little drop. Wouldn't have been anything significant. Going over to the current price action of BTC, is there anything in particular that stands out? Not really. This is kind of like an inverted head and shoulders. This is something that could be interesting. Again, another deformity and another deformed alternative of the formation would be the shoulders are higher whilst the head itself, this almost also a triple kind of formation here, but the head would essentially be inverted as if it's been compressed into the neck. So instead of trying to explain that, let me just show you what I mean. So in this particular instance, instead of the shoulder being lower than the head, so instead of the head being here, this is actually inverted. So what that kind of means is the formation is the same, but it's almost a trickery. So this could have been a nice reversal projection from this particular point in time. But what you would obviously have to do in this instance, because you cannot use the Fibonacci hit from here because the point is actually lower than the prior shoulder, what you would do in this instance is draw this from there, push this up to there, and as you can see, which is why there is a potential for BTC to do something quite wild, is look at the left shoulder, the A, B, C has already tapped, come back up, C's tapped again. So now we need to see how this level holds, but even from a long-term position, if you were to then enter from here, stop below the wick maybe, if you're going for a long-term swing, if this was to go to $51,000 or even to the first target over here, that's 4.5%, potentially even spanning up to 6.8%, 6.2%. So there's beautiful opportunities that can be continuously identified in this market. I do believe the 1 hour shows them quite frequently as well. Great example off the bat, another perfect example. Bang, 61.8 again. All we would do in this instance, just below the fib, plot that up, 3.5%, spanning even higher if you held 4.6%. It really is as simple as that, and there's really, you can't really get any better showcase than this. We are just finding them all over the place, and they continuously appear. No matter what you do, no matter where you go, the head and shoulders will always find a way to reveal itself. So even if we were to look maybe here, let's see what we can identify. This is a bit of a sloppy one. I wouldn't really consider that. Huge wick down there. Let's have a look for one more example. But again, the more I find, this more just for educational purposes. This would have been a very miniature one. We probably wouldn't have taken that because that was the shoulders, the head, the shoulders. It was perfect, but it also wasn't a very dominant one. So let's see what else we've got. Patterns, channels, we'll get to all of that very soon as well. The whole channel side kind of would have been one, would have been a bit of a break higher. You probably would have got stopped out on that one there in particular. Let's just find one more decent example. This kind of would have been the inverse one that we covered, where the head is a bit more inside, whereas the shoulders are more dominant and to the outside. But again, with a huge wick there, the trickery would have caught up to you. But this would have been a good example actually. Fell just short, that would have been a 50% retracement one. 50%, just fell short of the 50% even as well. In fact, no, we will scrap that because I don't want anyone looking for scenarios like that. Let's go to one more. As you can see, the 1 hour isn't as good, to be honest with you. The 4 hour is optimal, but also one thing that I'll show you is the monthly actually for BTC. And a general rule of thumb as well, something to pay attention to, is the higher the time frame, the stronger the formation is. So here, can you see this? Bang. So this was the support floor, and during this point in time, this was hilarious. For those of you who were following me, everyone said that this would not be able to break below $6,000 because it wouldn't be profitable for miners anymore, and they would all lose their money and Bitcoin would fail. And as we saw very quickly, it drove through. If we go to the weekly or even the daily, was there a retest here that would have really backed that up nicely? So yeah, so this is where the shorters come in. They would have actually made some money, to be fair to them. Then it came back up, broke through, retested and flew. So if we go back to that monthly or even the weekly, as we can see, it wasn't the cleanest, it was a bit messy, but all in all, a head and shoulders, which then formed the next catalyst for the market breakout. So if you go to the monthly, you can see how perfect that is. And again, good old bit of Fibonacci over here. As we can see, A, B, C. Obviously, we wouldn't have been able to go long from here because we would have been annihilated. But just to show you the formation is still very relevant, and to show you how that did lead up to a $20,000 movement, which has now been broken. So it'll be interesting to see what this does. Monthly is looking bearish at present, but let's get the head and shoulders up just to show you roughly what was going on here. So we knew if there was going to be, right, let's mark this out first. That was a terrible head and shoulders, absolutely terrible. Let's do that again. There we go. So there you can see very clearly, upon breaching higher, the false move, the retest, the breakout, the retest, boom. This is all you need to look for in the market. This is a rare exception because it was forming on the monthly. That's how I knew we would then pull back in 2019 to fill these lows. That's how I managed to predict this, to be honest with you. It was as simple as understanding a potential head and shoulders was on the card. But go into the likes of the weekly and stuff, it will always continuously appear. And you can see here quite clearly how that came into play. And using this for a long-term bias is crucial, especially for long-term investments. But when it comes to the daily and the 4 hour in particular, that's where you can really start to identify those juicy swing trade opportunities. So if you want to really utilize this on cryptocurrencies in particular, whether that's for XRP, LTC, Ether, they're quite frequent on Ether and LTC as well. And those are the more liquid trading pairs anyway. So if you want to be utilizing these opportunities, daily time frame for swing trades and potential even intradays, 4 hour for the exact same swing trades and potential intradays, and the exact same can then be mirrored on XRP, Ether, LTC in particular. They are the ones that have the most reoccurring and common patterns to identify. So keep that in mind and make sure you are hunting. You can use this on Forex as well. Go and practice on every chart. Train your eyes to identify these opportunities, and very soon you're going to see how this will massively benefit your trading. I can assure you this will revolutionize your trading. Everyone knows about the head and shoulders, but no one is actively training themselves to identify it. Because when you can learn to identify it, it pieces together everything that may be aiding your current bias anyway. So if it matches your bias, you've got a stronger confluence, you can take that trade more confidently.